And we're live. Today, I have Kempton Williams, whose probably biggest claim to fame is that you're my brother. When did you, as growing up, was there a moment in particular that you realized, wow, Raleigh's really special?
I'm still waiting to have that moment.
we
Maybe
don't
maybe it'll come right now.
we don't give verbal affirmations in our family. We're all in therapy about it. Okay, so Kempton, you posted not that long ago, and really from the time that I've known you, which has been from the time that I've born, you've always kind of had a job on the kind of that you're focused on. You're an accountant, so you've been a CFO. But outside of your job, you've always kind of been flipping houses, running houses on the side. How did that, when was the first time that you started doing that? Was that right out of college?
That I started doing what?
That you started buying houses? Did you kind of get into it because you bought a house and you're like, oh, I want to upgrade houses instead of selling? How did it all come to pass?
Okay, so we're diving right into housing.
We're going straight into it. Yeah.
Okay. So yeah, I mean, I think I kind of landed into it by accident. So not on purpose. I think so when I was leaving college and we were moving to Florida for me to start my master's in accounting program, I had a little bit of inheritance from one of my grandmothers, and with that money, I was allowed to put some money down on a home. And
20, 50, 100.
Say what?
20 grand, 50 grand, 100 grand.
Yeah, 20 grand. 20 grand is what I got to put down on a home. And so so I was really excited coming out of school, coming out of undergrad, to be able to buy, my first home. I was married at the time. Well, I still am. But I had already been married, and so we started looking at properties in Florida as our first kind of starter home. So that home that we ended up buying was about $200K, and to be fair, that money that I got from my family did help jumpstart buying my first home with a bigger deposit. Most people probably can't out of school afford to put $20K down on a home, but I was blessed to have that little bit of a head start with that additional money. And so when we bought that home, we knew it wasn't our forever home, but I didn't have any intention at the time to rent it out. The only thing that I can say is when I was in college, I did help property manage some properties for others. And so I had kind of been through the program of, making a home look nice, listing it on Zillow for rent, or Craigslist at the time is what we used to use for rent, and then vetting out tenants and finding tenants. So I had a little bit of experience, but I wasn't planning on applying that yet in my personal life.
Where was this relative to the housing crisis? This was
2008. So actually the first home that I bought was a foreclosure. So this was in 2008.
Like a short sale or REO?
It still hadn't hit. Well, actually, let me edit that. It was still a short sale. So I hadn't gone through the full foreclosure process yet. And the home that I bought had originally sold for $360,000 in 2005. And then I bought it for $208,000 in 2008. So that's the kind of value inflation that was occurring before, 2008. And then it went down. I mean, even from when I bought in, the market still continued to decline even more. I mean, my home lost value even after I bought the property.
And so in a short sale, did you have to bring extra cash? I don't know when FHA now FHA, you put 3% down. I don't know if that was a function of housing crisis or if that
existed. So this first home I didn't, because I was putting 20% down, I didn't have to go through the FHA program or have insurance,
Which I
mortgage
guess
insurance.
you were going to school.
I was going to school, yeah, and work. I was going to school and I started working. So I was working full time, going to school at night.
Oh.
And so, yeah, on this first home, it was a little bit of because I had more of a conventional mortgage. Yeah, short sales were, and I had helped people buy short sales when I was an undergrad, as kind of like not as a real estate person, but just as kind of like a real estate investor. I kind of helped scout out properties. And yeah, depending on the property, you have to have your ducks in a row. You got to have your financing in place, because a lot of times it's a multiple offer situation. And
you were getting financing based on this new job that you had in Tampa.
Yeah.
So you had this, how long did you stay in this house as you're getting your master's of accounting?
So in 2008, I bought the home, and then really what happened was in 2011 so after I'd been in the home for a couple of years, I was always looking. So as a hobby of mine, I was always kind of looking at real estate. I was always on Zillow at night. I was always looking at houses for no other reason other than I just enjoyed doing it. And so in 2011, I found, so over the course of a few years working, I had made some bonuses. I just graduated with my master's degree. I had kind of some cool things happen at work where I got a few bonuses that I was able to kind of save up. And so I started looking for my next property. And so that's when I found my next one. So I went from a $200,000 home to a $330,000 home that I ended up finding. And for me to do the $330,000 home, I didn't have, that was my first FHA loan, where I can't remember if it was 3.5% or 5%, but it was definitely through the FHA program.
So explain real brief what an FHA is, what you have to do.
So I think FHA stands for like first time home buyers or something. I'm not exactly sure. You can
Federal Housing Authority.
Oh, okay. Maybe Federal Housing Authority. Anyways, the way the program basically works is if you're moving into a home as your primary residence, so that's a key qualifying factor. The government has this program in place where you can it helps you obtain a mortgage at a lower down payment. So the thought process is if you're moving into the home, you're a less risky a tenant of the loan. Yeah. And so therefore there's a little bit of, it's not assistance, but they just allow that you don't have to go through a conventional loan, which normally you have to pay. Conventional loans, you have to pay 20% down. Right. But an FHA loan allows you to pay less than 20%. And there's varying degrees of how much less. You can do 3.5, you can do 5, I think you can do 10, maybe 15. And the kicker on an FHA loan is that although you can put a very low down payment on the home, you have to buy an additional insurance on your mortgage called mortgage insurance. Yep. And so that kind of helps whoever's doing the ultimate loan for you, whether it's Chase or Wells Fargo or Bank of America or whoever, have some insurance protection in place in case of a default. Yes. So that this program is only permissible if you are moving into the home. Right. So a lot of people ask me, how did you honestly, the hardest part of the whole deal is getting into that second home. Like your first home is pretty easy because you can do an FHA loan. I happen to have done a conventional loan because I had some inheritance money, but the first home for anyone is, as long as you have your debt to income ratio is adequate, you can usually qualify for a home with a very low down payment. But it's that second home that's going to be the biggest obstacle for people to overcome, because because you don't have any history of renting your home out or rental income, so when they're calculating your debt to income ratio, they're going to count the mortgage that you have on your first home plus the mortgage that you have on your second home.
Right.
And they're not going to offset that debt with future income that you're going to get from renting out
asset.
First home.
Yeah.
So that's kind of of the whole deal. The hardest part is getting over that hump where you can work it out so that you can qualify for 2 loans, whether it's you have enough income from it or your deposits, your down payment's bigger. You have to figure out how to get through that second home with not having any rental income experience. After you get through that second home, it's easy because as soon as you have 1 year or 2 years of tax returns showing rental income on your properties, banks will look at you as a more sophisticated candidate and will allow you to kind of keep progressing and keep adding loans to your debt,
Right.
to your history. And so that's the hardest part of all of it, is qualifying for that second loan without having any rental income offset for them to look at your debt to income ratio. Because you got to keep it under like 50%, like your total debt, your total monthly payments that you have each month, your mortgage, your car payments, your insurance, credit card minimum payments, all of your debt needs to be less than 50% of your income, how much you're making from work through a W-2 employer. If you're not making money through a W-2 employer as an employee, you need to have 2 years of business income.
And
so it's that second home that's the hardest. Once you get past the second home and then you get into a routine of renting out homes, it becomes much easier for the third.
And they don't let you roll multiple FHAs, right? Because the whole point of the FHA is you have to be claiming it as your.
So that was what I thought. And I don't know this, so don't quote me on this, but through my experience, there was no limit. No one could ever answer for me, or as I progressed from FHA loan to FHA loan, no one ever told me you have too many. You're not allowed to do another one. It was almost like, as long as you had the intention to move into the home as your primary residence, there was no limit to how many you could do. There may actually be a limit.
Right.
I just never.
Because the most you had at one time was how many?
Maybe 5.
5 simultaneous FHA mortgages on 5 properties all at the same time.
Yeah. And to do that, what I had to do was move into each one. So when you're closing on an FHA loan, you have an affidavit you have to sign at title at closing that says you are moving into your home. And
right.
That's what is the most important part. I don't know if there's actually a limit of how many, like if you can close on a loan and 3 months later move into another property, and then close on a loan and 3 months later move into my cycle was never that fast. It was maybe the fastest was 18 months or something. And so I never reached an area where they said, nope, no more,
Yeah.
But I was always wondering how many more I could do. But and when I would research it, I couldn't find anything out about it. And whoever I was working with from a financing perspective didn't care. They just wanted to close a loan. So.
And you always preferred the FHA plus the PMI plus the private mortgage insurance, that extra couple $100 over going 10%, putting a.
Well, it wasn't that I preferred it.
Yeah.
It was the cash limitation. So the more cash I could have for my next deal
right.
in my bank, the better. So I always, so paying the mortgage insurance premium every month was a cost of me doing business this way. And there are, there was one home that I got to point. The mortgage insurance doesn't stay on the entire time. So
Once you get 20%.
there was one home that I actually got to a point where the value of the home
Hmm.
increased so much that I was able to refinance 2 years later,
Out
and
of an
remove
FHA.
the mortgage insurance off. Not because I had paid down significantly less cash or more cash. It was just because the value, my loan to value changed because the value of the home substantially increased.
Now that you've had properties that you rent out and the FHA, I mean, because FHA normally sets limits based on where you live. You can get up to a
Yeah.
4-unit complex, and what you get in Tampa, Florida for an FHA is half of what you would get in an FHA in San Francisco.
There are FHA limits. Yeah, I would say for the most part, they're either anywhere from like, I mean, I don't know if there's a bottom limit, but they go up to maybe 350,000 now.
Yeah, well, I think it's based on in New York City. I think
Yeah, it does vary by area, but you're not gonna. I don't think you can do. I mean, yeah, maybe if you're in one of those big major markets, but for the most part, you're not going to buy a luxury home on an FHA loan.
Yeah, you can get multiple units though, right? 2, 3, 4-unit complexes. But what have you found now that you've had houses in the $600,000-700,000 range that you've rented out versus houses in the $200,000-300,000 range? Do you prefer the lower?
Yeah, and just to clarify, I mean, the way that I progressed into a higher market of homes, because FHA became not an option, it was a matter of savings, being successful at work, getting my year-end bonuses, applying them to my next, it was a combination of work and salary and bonus and savings on top of, renting out the homes that kind of made the dynamic all work and allow me to kind of progress upstream with more valuable homes each time.
And do you enjoy higher priced, higher value homes?
Yeah, so I like it because it's kind of like a niche market for me, so it works out. A lot of people play in the space of low income rental properties, apartments, and 3 to 1,500 square foot homes. And so I think that market is the most saturated in terms of competition and your eventual return on your cash. And so for me, what I found, and it may have been, again, I think it was by accident because all of these homes were my primary residence. We kind of wanted stuff we wanted to live in, so a lot of these homes had swimming pools, as an example, just because we always wanted to live in a house with a swimming pool. And as I would convert these primary homes that had features that we enjoyed, for my family, that my wife liked, to rental properties, we found that we were able to charge substantially more than neighboring properties, even within the same streets, just because of the features of the home that we had, because they were features that we would have only purchased for the use of our primary home.
And so what are some of the things now, as you look for to add to your rental properties, what are the...
So now I'm moving into, I've gone kind of higher up in market. And so now something that I've really enjoyed doing the last few years, which has kind of entered in like a whole new space for me, has been executive home, fully furnished style homes. And so now I'm starting to get into properties that we can advertise as, for people who are relocating for a new job, a higher level job. Maybe they have, kids that they're moving in and they want to check out the area for 6 months or 12 months before they decide where they want to live.
Yeah.
They don't want to bring all their furniture, because almost like an Airbnb, style home that you look for on Airbnb to go on a trip. That's basically what I'm mimicking as a long-term rental basis. So furnished, nice kind of touches in the home, your swimming pool, stuff that if you're, coming into a new city or a new market and you want to rent a place for a year, it's a place that you can feel really comfortable. And because that end of the market is so slim pickings, I'm able to charge way above market. I mean, for example, one of my homes in a neighborhood of 32 homes, there are probably 3 homes in that neighborhood that have tenants that you clear out the home, nothing fancy about the backyard, just grass, really clean home inside, but just a shell of a home, same square footage as same builder as my home, et cetera, et cetera. Could charge about $4,500 a month for rent, which is what, if you look on Zillow, it would say my rent zestimate is what they call it, which should be $4,500 a month, because that's what 2 or 3 in my neighborhood are renting for. But I've been able to charge $6,500, now even $7,000 at my latest renewal for the same cost basis, but with more feature intensive home and it being furnished. So,
yeah.
And when I say furnished, it's like furnished with like, Wayfair type stuff that's nice, that looks good, but we're not talking about restoration hardware type stuff that your cash is just sitting in the home, depreciating.
Right. What are some things that are, as you're looking at homes, and take me back to the 200, 300,000 FHA style homes. What are some things that are just red flag from obviously structurally and all that stuff to the side, the roof, all that, just from a ability to rent and potential issues that you could potentially have with renters, whether they're hard on certain stuff or features, no features, what's the balance?
Yeah, I mean, so I think by having the mindset of this is my primary home, you're going to filter out a lot of stuff that otherwise investors look at when they're just looking at properties online. So what are the types of things, if you're house shopping with your wife, that your wife or your husband or your boy or your whoever, that they say, oh, that's really nice. And you want the home to have something that really draws in a crowd, whether it's a nice master bath, a nice glass walk-in shower, a bright, inviting kitchen, nice quartz countertops, flooring. You just don't want a vanilla home if you're trying to eventually get kind of that extra. Because even in a neighborhood where, for example, I have a rental home that, the home was $260,000 is what I paid for the home. And then I probably put $50,000 into it in renovations just to update it a bit. And because of that, I'm able to get an extra $500 a month more than what it's worth online, just because when people, the nice thing about rental properties is there's no appraisal. There's no one going through the home before you sign a lease that says, nope, this isn't worth this rent. You have to accept the rent at this value. If someone gets emotionally connected to your property, and there's people moving in and out of these major markets all the time that need a place, they want something that's nice, or even in Texas where we have properties, we have families who their houses get burned down or tornadoes or whatever, and their insurance companies are paying for them to temporarily stay in a hotel. So they're just trying to find something that's comparable to what they lived in before, and their insurance companies will pay the rent. It's whatever they perceive the value to be to them. So it doesn't matter if your home is only $300,000, you can rent it as if it was a home for 500,000 if someone makes an emotional connection to features that are in your property. So I like things like a nice master bath, nice, updated kitchen, even if it's small, something that's nice. Throw in like one of my homes, I found a Viking oven on Craigslist, for $800 that I incorporated into my kitchen, which just people go, oh, it's got a Viking oven, even though I bought it at some random place and, the guy probably didn't even own it, who sold it to me. And so there's ways to kind of make a nice house that people can make an emotional connection to and pay you that extra $300 a month, that extra $400 a month, than what the market tells you your property's worth, just by you finding stuff that has some interesting features to it.
How do you compare, how do you try to go about underwriting potential rent? If you're going into a new market, you don't know the neighborhood super well, or maybe you do, just trying to underwrite rent relative, whether the rent and your carrying cost of trying to get it rented relative to your relative to what you think you can actually get for it from a rental perspective. Is that hitting the ground with realtors? Is that the Zestimate?
Yeah. So, I mean, I would say you always start with the Zestimate. You can use a realtor, and you can look even online yourself at, homes that have recently rented. The nice thing about rental, if they go through the MLS, there's data on what they eventually were rented for. And so you can get a good perspective that way. Like, again, one of my neighborhood, but it's not, you can't just rely on that. A lot of it, you just got to rely on what you're trying to achieve too, or what kind of return you're trying to get on your own investment. Like if I relied on recently rented properties in my other neighborhood where there's 3 that rent for $4,500, I would have rented it maybe for $4,800, but instead I rented it for $6,000, just because I knew that that's what I wanted to get out of it. That's what I thought it was worth. And the other thing that I kind of benefited from is because I've lived in a few different states and then internationally for work, and we've lived in furnished homes overseas. I have a good perception of what you can get for homes in many different markets based on the features. And I'm telling you, the stuff that moves, the stuff that, becomes a bidding war, the stuff that you can charge an extra $500 in rent is when you get 2 or 3 passionate husbands or wives who find something about the home that they really want, and they want yours, and they'll pay that extra $500 a month just to beat the next guy.
Yeah.
No appraisals needed, just emotion.
How do you go about marketing it usually once you're ready to rent it out? And
I've always done it myself. A lot of people ask me about property management. I've always managed the properties myself because I was just so greedy about that return. I wanted, every dollar I could get from it. And I found that it wasn't that much work, and I was able to kind of absorb it while I lived domestically in the US. The only time even when I lived internationally, I still managed it myself. I came up with solutions so that my tenants could let me know if they need anything. As an example, like I started pulling home warranty policies out. So you can go to like American Home Shield and pull a policy out on your home, whether it's rented or it's your own private home, you can. And so I would do something like that where I would pay like $80 a month for a home insurance policy that then basically, if my tenants had any problem, plumbing, electrical, AC, even pool equipment could be covered. I set it up so they could submit the tickets directly to them, and then it was basically covered. But the only thing that I kind of outsourced when I was living overseas was the advertising of the homes, because I couldn't show the homes physically anymore myself like I could when I was living in the US or even in the same state. That's when I would hire a realtor to do and realtors for the most part don't like to do listings for rentals. There's not a lot of money. It's not a percentage of, it can be a percentage of the rent, but usually they'll do it for a flat fee that you can pre-negotiate.
$5,000, $3,000.
Yeah. So I think, usually the flat fee should be something less than what 1 month's rent is. You should, but even still, I have friends in Nashville where I live now who they rent out properties on the MLS for a flat $300 fee, just because they're just doing volume. So they'll list it and just churn and burn and hope they get hope they get whoever they're showing the property to on the other side when they go to actually buy their first home or whatever. And so you can list on the MLS even flat, you can do flat fee listings. You can pay websites $300 or $100 to list your home. And then you vet all the calls, you do all the showings. It just depends what stage in your life you are professionally and personally. I've evolved from doing everything myself, every showing myself, needing to save every dollar, to now I'm more open to professionals doing the work, just because I am more diversified in how I spend my time.
Right. And what do you do currently in terms of managing? You have somebody getting into it. You have to figure out. Obviously, there's the house criteria, and then you have the whole other side of how do you underwrite a tenant? How do you get a lease? How do you how did you go about navigating those at first, as you were first coming across those? A new lease, is this tenant creditworthy?
So the first thing you do is you create an application process. So the first thing, if you list, like I did for many years, I would just list it on Zillow. I always rented my properties, just using Zillow by owner. I never had any problem. And the first thing you need to do is, when people say, okay, they come and and this is the benefit of showing the home yourself. You actually get to see who's coming. It's your home. You want to make sure. I have never had a terrible experience in terms of a tenant occupancy. I've had tenants who, I've had to spend some good money repainting and whatever after a very long tenancy. I've had some tenants be slow on rent. I've had, but then end up catching up. And then I've had tenants who, just couldn't afford it anymore, that had to move out, but I never had to go through the full eviction process. Moved out. They moved out amicably. So I lost a month or two of rent at the end of the day because we just parted ways. But for the most part, I've had very good experiences with tenants and care. And I think a lot of it has to do with the market that I play in, it being, 200, 300, to $800,000 properties. And so the families are in a different stage of life. No one's working at McDonald's as their primary income.
Right.
And then B, I've got to physically vet out these you learn a lot when you tour your own home. You see the kids, how excited they are about the rooms. You see how the parents react. You can smell if they're smokers. You can figure out a lot by just showing your home yourself, and it saves you money. And then 3, application. I always had, I use the same application form that I started 8 years ago. It was literally just, I looked on Google Docs, images for tenant applications, and you'll find hundreds of different options. And I probably pieced a few together that I liked. And it's just a 1-page application form. So when they're leaving my house and they're like, what's the next step? Well, the next step is you fill out this application It's got employment verification. It's got, all these things. And then I have it, and I could do what I want. In the early years, I never even did credit checks. I just went off of what their income was. And a big question for me is what are you used to paying for rent?
Yeah.
So I've weeded out a lot of tenants or prospective tenants who come to my house with big eyes. We can make this work. And my rent's $3,000, and the last rent that they've done is $1,500,
Right.
And so you get that application versus someone that's been paying $2,500, and you go, okay, I'd rather take my chances on the person that's going $500 up in rent than the person who's doubling their monthly expense for rent. So I always kind of process these applications myself. For the longest time, I cared about pets. I cared about how much money they make, what kind of companies, that they worked for. But I never did credit checks. And now these latter years, I do credit checks. So now, there's platforms you can use, especially if you're doing it through a realtor, where, they'll get a link, they'll have to pay for it. I never charged them in the early years an application fee. But now you can make it so you send your prospective tenant a link to a website, and they type in, instead of writing it on your paper, all of their employment information, social security numbers, and then you actually get a credit report. Yeah. And you, as the landlord, get this kind of nice, credit report on what your tenant's, rating is.
Which Zillow does. If you go through a Zillow rental manager now, if they apply through Zillow, they'll do all that and give
exactly
you eviction.
So there's you can do. I guess my point is you can do it as homegrown as I did, where I was advertising on Zillow and Craigslist. I was taking my own phone calls. I was showing my own properties, doing my own application that I created in Word that they would scan and email me. I created my own lease, just through online research.
Yeah.
And so you can do all that, or you can go, if you're doing it through Zillow Property Manager, they have all these tools now. If you do it through a realtor, your realtor will guide you through the whole process. So there's a host of ways to kind of filter it through. But the key for me was always, in terms of choosing one applicant over another, was how much are you used to paying in rent, and for how long?
Yeah. Yeah, I think that there are a lot of people that get overwhelmed because they come from a professional background, and so they try to run their rental properties in a very professional way and add a lot of layers and make the process overly complex. So they just decide to not do it at all because they're like, oh, I need to get a property management company.
It becomes overwhelming. And then with all those layers and processes, it becomes expensive.
Yeah.
And then you just don't ever see the money. Like, I did it kind of bootstrap every step of the way, even to this day, because if there was money to be made on my home, I wanted it to come to me.
Yeah.
And I was willing to take the time to make that happen.
So on your next deal, what's the next deal you think you're going to do?
Well, so like right now I live in a $1.5 million home, and people would look at that and say, there's no way that can be a rental property. And I look at it and I go, I love that everyone says that, because it tells me that no one's tapping into that market.
Yeah.
So I know, hands down, when I'm ready to move to my next home, a $1.5 million home can make a great rental property, because there's someone that's moving into my city who wants to live in a sick place and is willing to pay a premium while they sort out the area. Because I would have, when I moved in, I wish I didn't have to close on my house before we even moved into the city, and that we didn't even get to pick which schools, because people's circumstances are so different. And there are hundreds of people moving into cities each day, and there's tens, or 20 different reasons and structures to how and why they're moving. And so you just need a few that kind of fit into that niche, and all of a sudden you have yourself some good cash on cash return.
Yeah. I like it. Okay, I'm gonna go on Zillow right now and get working on the next one. You've also lent to me on some house deals, so I'll be hitting you up on the lending on that. All right, man, appreciate it, and say what's up to mom.
See you, man.
Peace.